Hi, it's Joni Michaels, and it's my pleasure to introduce you to Joe Clark, host of Consider This Program. Joe's a certified financial planner and former professor at Purdue University. He's the managing partner for the Financial Enhancement Group. Joe's passion is teaching people about their money so they don't make inefficient financial decisions that lead to frustration and devastation. The Financial Enhancement Group serves more than 900 families in 31 states and manages more than $400 million. The Financial Enhancement Group takes care of people who don't want to worry about their money so they don't make inefficient financial decisions. Joe addresses your questions about money in 5 critical elements of finance: retirement planning, or what we like to call your life after work, tax planning, investment planning, life happens, the good, the bad, and the ugly of life, and legacy planning. The Financial Enhancement Group can be reached at 800-928-4001 or visit yourlifeafterwork.com. The Financial Enhancement Group is an SEC-registered investment advisor. Securities offered through World Equity Group, Inc., member FINRA, SIPC.
Well, good morning and welcome to Consider This. I'm your host, Joe Clark.
I'm Ken Dilger.
And I'm Angie Kinzer.
Happy to have you along. Angie's got something here as we go into the end of the year and the Christmas season that she wants to share.
Yes, first I want to ask you both, do you know what a porch pirate is?
A porch
Of course, it's
pirate.
been on the news for the last month.
Aha. That would be the only reason that I knew. Now that you said that, it's kind of like, okay, I got it.
Yes, well.
This is why my daughters have her packages dropped off at our house instead of left outside her apartment door.
Yes,
Got
yes. One of the big insurance companies conducted a survey, and they've found that 59.4 million Americans have had a package stolen from their porch or doorstep. But 26 million of them are stolen during the month of December. So,
Wow, so almost half, but 54 million have had one stolen. So you're dealing with 1/6 of America for all intents and purposes. In terms of households, that would actually even be greater. Households are somewhere around 75 million. So, I mean, that's almost 75% of the houses.
I know. I know.
Holy cow, Batman.
Well, and they gave a couple other kind of interesting facts about holiday hazards is what it fell under. And one of them is about fires. It says that 9 million have experienced a fire from cooking, 13.2 from candles, 13 from overpacked electrical outlets, and then 9.9 million from fireplace.
Why do I see the picture of Clark Griswold?
Yeah, I know.
And National, and the box plugged in. I love Christmas.
It exactly is what reminds me of. It says fires jumped 20% during the holidays.
I can see that from the overplug in. What's your favorite Christmas your Christmas show that you're going to watch, Ken?
Oh, boy, there's a bunch of them. Christmas Vacation, Elf, or,
You're not one of the old timers then.
No.
Why, what were you going to say, Rudolph?
Well, I love It's a Wonderful Life.
Yes.
With George Bailey.
Yes.
And we had 4 or 5 people I talked to the other day had never even heard of it.
I've seen it a couple times.
I've never even heard of it. How do you not know who George Bailey is? Right?
Yes.
I mean, come on.
I like the old ones. I also love Elf.
All right.
And
Yeah.
I
Elf
just
and Will
watched
Ferrell.
Like Elf.
I go to Northview
Christmas Story.
Christian Church down in Indianapolis. We have a movie series that we bring in where we take the movie. We don't agree with everything they say, but Pastor Poe breaks it down and says, here's what you can take away. And 2 weeks ago, we actually did Elf. This last week was The Grinch. You got to love Jim Carrey, how The Grinch Stole Christmas, and Lucy Liu, and not Lucy Liu, was it Louis? Yeah, maybe it was Lucy Liu. I don't know. Anyhow, the little girl with the pigtails did a great job. Hey, you're listening to Consider This. I'm Joe Clark along with Ken Dilger, Angie Kinzer. We'll take a break and be right back.
Hi, Joni Michaels here. We know you care about your money, but are you tired of worrying about it? The Financial Enhancement Group takes care of people just like you who don't want to worry about their money. As fiduciaries, the team at the Financial Enhancement Group will care for your nest egg just like they would care for their own if they were in your situation. There are many decisions you'll need to make as you face retirement, and the team at the Financial Enhancement Group is here to help you. Call 800-928-4001 or go to yourlifeafterwork.com to set up a time to meet. The confusion and complexity of retirement is almost as daunting as is the excitement of retirement. Don't let your fear and frustration of taxes and investing derail your retirement. Call the Financial Enhancement Group at 800-928-4001. They'll give you a complimentary second opinion on your strategy for retirement. Begin your adventure in your life after work. Call 800-928-4001 or yourlifeafterwork.com. Now back to Consider This program with Joe Clark.
Hi, I'm Joe Clark, host of Consider This. We're dealing this week with a question that came in over ESG investing. No, that is not a ticker symbol. It's environmental, social, and governance-related investment issues. Welcome to Consider This. I'm Joe Clark, your host.
I'm Ken Dilger.
And I'm Angie Kinzer.
Happy to have you both along as we go into this Christmas season. It is almost hard to imagine that the decade is coming to an end. If you would have asked me this question over ESG investing in 2009, the answer would be entirely different than it would be in 2019 as we head into 2020. Ken, I do not do well when somebody questions my integrity.
So true.
I just have to tell you this. I take it quite personally, and hairs stand up, and things just don't go well. So we have been managing money in central Indiana for churches, many people, but churches that have what we would call social policies. You know, don't invest in tobacco, don't invest in alcohol, don't do this, don't do that. And so we now have an office, and this show's listened to all over the country, so some of you may be listening, but you'll get the humor out of this. We now have an office in Bozeman, Montana, that has many families in Seattle that we take care of. And the planner out there, who I care about dearly, Sarah Hussey, is another certified financial planner and part of our team. And Sarah says, you know, Joe, in her almost southern accent, even though she's from Montana, do you guys believe in social-oriented investing for some of our families? And it's, well, if that's what we need to do, we can build those portfolios. And then all of a sudden she calls me one day and is almost screaming. And she is mad. And she goes, "What? This is not socially oriented investing." And I said, "What are you talking about?" And what they mean in social out in Seattle is an entire difference than what we mean socially acceptable here in Indiana. Might I just say it's more environmentally driven that it seems to come from the West Coast.
And also, since you mentioned churches and them being a lot of us, I would like to invite everyone to join us on January 4th when Aaron Rayum, one of our advisors, is going to talk about when God is your portfolio manager, and it kind of links to some of the beliefs in the churches.
He's part of our the Kingdom Advisor Group down in Indianapolis, and we actually have a program internally called the Better Giver. But very, very happy to have Aaron on the program and as part of that. So, Angie, this is your show. Anybody who has a question or comment gets to call in and talk to Angie. She's our point of first contact. If you want to come in and have your portfolio discussed and your retirement strategies put together, you can give her a call at 800-928-4001, and Angie's the one that you get to talk to. So go ahead, Angie, fire away your questions.
Well, we've had questions before asking about our investment processes. And so this question was, why is it important to have so many different points of view? And so I thought this might be a good time for you to explain what, who, and how the allocation team works.
We're going to do that in the rest of the show. I'm going to we have a four-legged strategy that we use at the Financial Enhancement Group. One of those is the narrative leg. It's looking at the big story, the demographics, if you will. I'll break that down for you. The second one is the fundamental leg, and we're going to have Adam Harder, a CFA, Chartered Financial Analyst, and one of my partners on to discuss how fundamental analysis works. The third will be Andrew Thrasher. He'll come in and talk about, he's a chartered market technician, an award-winning, I should say. He was the youngest winner of the Dow Award in history, and the Charles Dow Award, an expert in especially volatility. But he's going to talk about how we use or don't use technical analysis in constructing ESG-specific portfolios. And so then you'll have a better idea. And for those of you that are new to the show, Ken will tell you, as well, Angie, we don't normally talk about investing on the show. That's not what it's designed to do. But we had enough questions. We thought it would be a good time to put together. So when we talk about a strategy, Angie, there's a few that typically come out. Ken, if I say a balanced portfolio, what does that mean to you?
It means that you invest in different, market segments across the industries, whether it's financial, utilities, that sort of thing.
That would be a great guess.
Nope.
But
wrong?
Not quite. That's diversified. Balanced, and this is important to understand. Balanced is when you want to make sure that you have the same number of cookies That's what we call 45-pound plates. The same number of cookies on both sides of the bar, right?
Gotcha.
Otherwise you get into trouble, right? The more cookies you have, the more problematic this could become very, very quickly. Many portfolios will have people who come in who say, I'm a balanced investor, and they want to have 60% in equities at all times and 40% in fixed income or bonds at all times. That is just one of theirs. That's the strategy that we use. We don't believe anything should ever be that static, right? So if the portfolios are looking like, if the market looks like it's poised to move positively, we will increase the equity exposure, or on the other side, if our risk barometer says that it's negative, we'll decrease it. But that's what a balanced portfolio is. Another portfolio, Angie, is a strategy is when somebody comes in who wants to look for a portfolio who lives off of the dividends. Now, this is what gets to be very confusing for some people. When a company pays a dividend, it has a dividend yield, right? That's the way we look at it. Does that yield change, or is it consistent, Angie? What do you think?
I don't know.
No idea, huh? Ken, what do you think?
I would think it changes with I would guess, the net income that they're trying to distribute to the stockholders.
It can change in one of two ways. It can change with the amount of income that they distribute via the dividend. It can also change with the share price, which is where most of that change comes from. So let's say your stock, ABC, is $100 a share, right? And the dividend that it pays is $5 a share, right? Then you would say that it has a $5 yield, or 5% yield, rather.
Okay.
If all of a sudden the stock rose to $200 a share, and the dividend didn't change, the profitability didn't change, just the share price, then suddenly your dividend yield, now at a $200 stock with a $5 dividend, would drop to 2.5%. Make sense?
Got it.
So there are people who, one, live off of dividends only. They don't want to own any bonds. They don't want to have any stocks that don't pay dividends. And they like the idea that they have stocks that the dividend is totally paid for their price. Apple is one of those examples. We're long Apple. That just means we own it. For the people who were here, we bought it in 2006, and we've received more dividends than what we've paid for the stock. And so it just makes Adam's little tail wag, that we have positions that are like that. We have a few others that are there. But we do not buy stocks just because they pay dividends. We do look for companies that are good value, but some people have that definite strategy in terms of where they are. There are other people that are subject to taxation all the time. So we're not talking about an IRA or a 401k that only want to buy things that grow. Said I'll use my bank account for income. I will use my bonds for income. I want to invest in companies that are going to keep all of the capital and just keep reinvesting in their own company by either buying other businesses or creating new products. And so they don't want companies that pay dividends. That keeps stuff off your tax return every year, and it's just a different strategy. So those are three strategies. There's plenty of them that are out there. ESG is just a short little term that says, hey, do we want to buy companies that are environmentally aware, cognizant of what's going on? Do we want to buy socially driven companies that may not take care of, may not invest in companies that are socially irresponsible, according to some, in one way or the other, and you can get to a lot of arguments over that. And then the last, of course, is governance, how your business is ran. You're listening to Consider This. I'm your host, Joe Clark, along with Ken Dilger and Angie Kinzer. We'll take a break. Give us a call, 800-928-4001.
Hi, Joni Michaels here. Joe's been hosting financial radio programs for over 20 years, and during his 7 years at Purdue, Joe developed the 5 critical elements. You see, there are 5 areas we all go through that can impact and even derail our retirement plans. YourLifeAfterWork.com has been focused on you, on your retirement for over 20 years. You may have had a 401k as well as IRAs. Those are all defined contribution plans. Consider This program is about your defined contribution plans becoming defined distributions. You see, we all exit. You'll either take money out of those retirement plans when you decide or when the IRS decides, or your heirs will have to deal with the situation, but we all exit. I encourage you to call 800-928-4001 to meet with one of the talented financial advisors at the Financial Enhancement Group. I've listened to this show for years, and what Joe says just makes sense. Don't you think it's time for you to call 800-928-4001, yourlifeafterwork.com. Now let's get back to the show.
Well, good morning and welcome back to Consider This. I'm your host, Joe Clark.
I'm Ken Dilger.
And I'm Angie Kinzer.
So for those of you who don't know, this show is not about how to invest. And I rarely ever talk about it, but we got a great question that came in from Angie on do we use ESG investing? So the E in that stands for environmental, the S is social, the G is governance, and we're talking about buying portfolios or buying positions, investments, through another lens, another portfolio, or another lens, if you will, other than just profits and earnings. Are they socially aware? Are they environmentally conscious? And do they have good corporate governance? ESG. And we talked about that in the last segment. If you missed a little bit of that, don't forget you can always download the show, our podcast. Regardless of where you're listening, there's more to the show than what you're getting right now. You can download the podcast at Consider This Program. I'm happy to have you along. You can leave your comments there as well. And, of course, you can go to our website at yourlifeafterwork.com to get signed up for the Market Carver, our newspaper column, things like that. Angie Kinzer is the hostess with the mostest. She's the one who comes up with the questions, our point of first contact. If you have a question or if you want to come in and visit us at the Financial Enhancement Group, you can give her a call at 800-928-4001. Angie, your questions, please.
Well, I know you've always been about storytelling.
Yes.
So that's kind of what the narrative aspect of it is. And so what I wonder is, I think what I read is that early on, the narrative was pretty much how portfolios were put together, and things have kind of changed as far as, now using more, math and using more kind of technical analysis. So why do you think that's changed? Because we all love a good story.
Very good. Ken, will you tell me a story?
I'm not a big storyteller.
I find that
stories.
shocking. Oh,
Why?
No, whoa. You don't tell me you don't have stories. You have plenty of stories.
Well, stories I just can't tell on the air.
So think back. You're raising your kids. He's going to be a junior.
Zach's a junior and Jess is a sophomore.
And at IU though.
Yes.
She's a little older. So all right. So as a parent, I had two daughters. Mine are a little older than yours, but I know the common question that we would ask when they did something that just appeared bonehead stupid was why, right?
So true.
What in the world was possibly going on in your mind when this happened? What were you thinking, right? Why? And you should never ask anybody why unless you would have put them on the defensive. Just as, Craig Voss, who's going to be on the show, is the top FBI negotiator for hostage situations in the world. Awesome dude, friend of mine. And that's one of the things that he's taught me is unless you want to put somebody on the defense and go bad places, do not ever ask why. Just bad things happen. But anytime I was on CNBC and would go on and talk about the market, people would always say, well, why did that happen? Because we have this natural desire to believe that we can have an answer. Right? If I knew the market went up, because that's the only thing I know at the end of the day, right? There's more buyers than sellers, or at least on the positive ledger. Believe it or not, it doesn't even have to be equal. But why did it happen? Well, because we reached a trade deal with China, right? Or why did the market go up? Well, because the unemployment rate went lower and more people are going to have money at Christmas time to be able to spend. Or why did the market go down? Well, that silly hurricane came in unexpectedly, did a lot more destruction than we thought. We want to come up with these whys. And what in our opinion, and it depends where you fly economically on this, right? So some people are a supply-based, in fact, most economists are supply-based people, right? And this is what's taught in economic schools today. Supply-based means Field of Dreams, Ken. Remember the show? So
build it and they will come.
If you build it, they will buy it in this case, right? If you build it, that's what, when you were at school at the University of Illinois and you had that economics class that you rarely went to, One of the things that the professor tried to teach you most likely was that if you build it, they would come. If the Colts could field a team, people would buy the tickets. Now, I would bet if you think back in your career, what the Irsay family would remind you is that if you fielded a team that won, there would be more tickets that were bought than if there were less victories. Is that fair?
So true.
Somehow or another, I remember that, being there watching you play football on Sundays for so many years. So there's a lot of people, in fact, most people believe that it's if you build it, they will buy it economy. I disagree. I'm a demand-driven. I believe you will buy things that you need, or i.e. want in some cases. The greater your discretionary income, the more you want, the less you need. Now, I can tell you the weakness in some of this, but let's go through the first part. Ken, you and I know, and we've been raised, and Angie and I are the same age, so we were raised in a world where we are not technically baby boomers. When you go in and you look at this baby boom population, the sociologist, again, in school would have told you that group of people started in 1946. It ended in 1964. It would almost have you believe that was kind of a flat line of new babies that were being born, though. What you need to understand if you're listening to the show is that is not the correct answer. It was actually very, very much a peak that peaked in 1957. It stayed pretty well level. I call it the Bart Simpson head, if you think about how that cartoon looked, between 1957 and 1961, and then began to to fall off of a cliff very quickly, which is probably why they ended it in 1964. I was born in 66, so I'm getting ready to turn 53 here on Christmas Eve. And I am not part of that baby boom. I'm part of the X generation. Now, I love sociology. I love behavioral finance. But when it comes to investing, I really don't give a rip. What I care about is that demand. I care about what Angie needs at her age. I care about what Ken needs at his age. I care about what the mass of those people between 1957 and 1961 that were born are buying today. I want to know what they're getting ready to buy, Angie, and I want to know what they're getting ready to stop buying, Ken, right? Because that makes all of the difference in the world. When you go to a Home Depot, for instance, we know people buy their first home. It's been moved back a little bit, but they tend to buy their first home between 25 and 27 years old. They buy their largest home, or what we call their McMansion. That tends to happen later in life. When you bought your first home, if you were thinking and had parents that helped you, you knew you didn't care about a 20-year roof warranty. And so you bought a roof that might have been a little bit thinner in the, you go by our neighborhood that I live in my house now, and a nuclear bomb could go off, and our shingles may still be there, right, on top of the roof. And you can go to a Home Depot and find, in my opinion, and they would tell you if they were being honest, the age of the population around that given store, because it's the age of people who are buying shingles, whether this is their permanent home, what some would call their McMansion, or if this is their starter home in terms of where they are. I want to know what people are buying, where that demand is. So, Angie, when I look at the portfolio, my job is to try to find things that we're moving toward buying en masse, and to tell Adam and Andrew that, hey, I have issues with things that we're moving away from. Now, Adam pays more attention fundamentally because that means earnings could change, and he cares about the earnings. Andrew doesn't care because his perspective is a little bit more short-term than mine is. Does that make sense?
Yes.
Cool. So there's a lot of different ways to run a portfolio. What I will tell you is I have seen weaknesses in the demographics only. You can get into trouble when you try to explain why, right? So just don't ask that question, as Chris Voss would say. Just don't do it. There's no reason for it. We don't know why. We can give you ideas, we can give you insight. But to build your portfolio on nothing but the story by itself is absolutely dangerous. Hey, give us a call, 800-928-4001. If you want to do this on your own, that's your business. If you're looking for a fiduciary, that's our business.
Hi, Joni Michaels here. We know you care about your money, but are you tired of worrying about it? The Financial Enhancement Group takes care of people just like you who don't want to worry about their money. As fiduciaries, the team at the Financial Enhancement Group will care for your nest egg just like they would care for their own. If they were in your situation, there are many decisions you'll need to make as you face retirement, and the team at the Financial Enhancement Group is here to help you. Call 800-928-4001 or go to yourlifeafterwork.com to set up a time to meet. The confusion and complexity of retirement is almost as daunting as is the excitement of retirement. Don't let your fear and frustration of taxes and investing derail your retirement. Call the Financial Enhancement Group at 800-928-4001. They'll give you a complimentary second opinion on your strategy for retirement. Begin your adventure in your life after work. Call 800-928-4001 or yourlifeafterwork.com. Now back to Consider This program with Joe Clark.
Well, good morning and welcome back to Consider This. I'm your host, Joe Clark.
And I'm Angie Kinzer.
And we're along with our chief investment strategist here at the Financial Enhancement Group, one of my partners, Adam Harder. Adam is a CFA, chartered financial analyst, been with the firm for almost 19 years now. It's hard to imagine that, but he is in charge of the investment team. As well as being a CFA. His love in life is fundamentals. If you're new to the show this week, we don't normally talk about the market and investing, but we are talking this week a little bit about the differences between the narrative, or what we call the big picture investing, fundamental analysis, and technical analysis. We'll have Andrew Thrasher on here in a little bit. But Adam, why don't you go ahead first? Welcome to the show.
Thank you.
Happy to have you. Why don't you go ahead and give us a quick overview of what you would call fundamental analysis?
A quick overview.
Yeah, that means it's not a 2-day radio show.
Oh, I'd say it's just a broad category of ways to disappoint people. That's and that's because usually payoffs in investing when you get happy come in the short run, and fundamentals are geared towards the long run. So, but fundamental analysis, I think, is important to determine and evaluate what it is you're buying. In many ways, many types of investing, or many investors in the technical world, don't care what it is you're investing in. But it is a way to inspect and evaluate, to look at it, get a sense of how much something is worth, and then you can put that relative to what you're paying for it, is the simplest way that I could put it in just a few minutes.
Well, and that's pretty much what you help us with here on the team. So why don't you give the broad overview of how we use that perspective at the Financial Enhancement Group as we build portfolios?
Oh, sure, absolutely. And so when we're talking about fundamentals here, and when I joke about it being a good way to disappoint people, I think that's because we've been in such a good, long trending up market. They are more valuable when the tide goes out, and when things expose the more weaker parts of the economy and weaker parts of the segments. And so when I look at fundamentals and how we use it, is really more on an individual investment basis. So it's much more difficult to look at a broader market and apply a whole lot of fundamental merit to it. Because by and large, when you're looking at the S&P 500, you're going to see 500 companies that are largely viable, so to speak. But the real value is drilling in and looking at individual companies, rather than trying to determine what the fundamental characteristics are of the market as a whole. So we like to use individual stocks. That's been a staple of our portfolios. And so when you're jumping out on a limb and buying one stock as opposed to 300 or 400 or 500 that may be inside of one fund, you have to be sure that what you're owning is going to be viable when you're sticking your neck out and purchasing one company.
And so we look at it from a multiple perspective, if you will, technically, which you're going to learn about with Andrew, fundamentally, and then we hopefully it matches up with the big picture, what we call the narrative along with it. Now, what led to all these questions, Adam, today is we got a question in on ESG investing. And if you're new to the terminology, E stands for, let's just think environmentally conscious investors. Social, the S is the social. Those are people that may have a different view on what is good for the environment or good for social causes. And then the last is governance, in terms of how the company is ran, its brand name performance, and everything else. So when I ask you to do this, I got the typical, Adam, I don't want to talk about this look, because we don't like individual strategies. We like to find individual companies that make sense. So why don't you go ahead and run with that so that we have an answer?
Well, no, you got that for me, because this is my least favorite topic in all of investing. It is actually the hardest thing to my job, because of that middle one, the S, the social. And that's because we represent people across this country. And so that S, social, means different things to different people. I have had people who will tell me, how do we make sure that the money we go in, it doesn't go into fund or pay for abortions. I've had companies that will want to make sure that they treat marriage and favor marriage equality and don't discriminate based on sexual preference. So we have liberals, we have Democrats, conservative, Republican, all those things push for different things, and that's the toughest thing when you're looking at an individual company. And so when you got that from me, that's the difficult piece I get.
It's the S. The E, go ahead with the E.
The E is peculiar as well because that's the environmental. And yes, I mean, more and more of us want to see our money go to promote a healthy, sustaining world that we live in. But it's very difficult now to find a well-managed company that doesn't have some sort of proper language about their green program, about their participation for a green climate, for their initiatives to take care of things. So, finding companies that stand out on a limb against that, yeah, sure, you can point against coal companies or things that are clearly, impairing the environment. But that group gets really, really, really subjective.
We pointed out on the Market Carver, and by the way, if you're not signed up for that, you ought to go to our website at yourlifeafterwork.com. You can get a free video we send out every week that explains some of our feelings on this stuff. Either I do the video or Adam himself does the video. That'll go right to your inbox on Thursday. But Adam, we had a conversation about the E, if you will, with muni bonds on the Market Carver probably a month ago, where Moody's said, hey, nobody talked 5 years ago about the environment and their bond rating, and now we're going and 9 out of 10 companies talked about the environment and their bond rating. And you gave me some graphs that we shared the difference between a Lexington, Kentucky toll road versus a Jacksonville, Florida municipal bond where the rate was actually lower in a place where you could have a hurricane, and they themselves were worried. So this one I'm interested in your opinion because I know what you've told me off air. So let's go to the G, the governance, the part. How do you look at that in the portfolio, and what do you think about people who are worried about how do you govern a company?
Yeah, so I mean, governance just in a nutshell, so we're all on the same page here. So what we're talking about is investing in public companies, and so the G, the governance, are the documents and the processes that are set up to make sure that the people running the company are running it for the people who own it and not for themselves, the managers. So there's a large series of steps you can do. The main thing I look for in investing is to make sure that there is good alignment between the management and the shareholders. So I can give you good examples of this. Our compliance don't like our individual portfolio companies to leak out there, but those good ones will require the CEO, the CFO, those in the C-suite to maintain a certain percentage of their net worth in stock, in the company stock. So those sorts of things can ensure that you have alignment between what they're trying to get done and the shareholders. And there's a lot more to it than that, but over and through time, that G, those companies that have good governance methodologies do show and tend to have better performance than those that don't. So there is a long-running justification for that piece of it.
And it's like most things, in my opinion. You've got most of the people in the world are good. We don't rob banks. We don't hijack cars. But every now and then you'll see somebody that has hijacked a balance sheet or has done things that are
Sure.
wrong. And that's one of the rules that we've had here since you've been here is if somebody commits accounting fraud and gets caught, we don't wait for the fallout. We're out of the stock.
Oh, sure, absolutely.
And that's so it does matter. Just understand most of the companies do really comply. So, Adam, any last final thoughts that you want to add into the fundamental analysis world?
No, I mean, I could just give you a good anecdote on the E part, the environmental. So one of those that like ESG investing, one of the companies they like very much is NextEra Energy. All right, they have a segment they're the largest producer of clean energy, and I got a pretty strong rebuttal from somebody who owns NextEra Energy because they found them to be socially irresponsible. Because of the way that they acquire land rights and trample on people's individual rights. So the poster child for environmental and climate responsibility can also be on the other side of the ledger.
Very good. Thank you, Adam Harder, Chief Investment Strategist and partner at the Financial Enhancement Group. We'll take a break and be right back.
Hi, Joni Michaels here. Joe's been hosting financial radio programs for over 20 years, and during his 7 years at Purdue, Joe developed the 5 critical elements. You see, there are 5 areas we all go through that can impact and even derail our retirement plans. YourLifeAfterWork.com has been focused on you on your retirement for over 20 years. You may have had a 401k as well as IRAs. Those are all defined contribution plans. Consider this program is about your defined contribution plans becoming defined distributions. You see, we all exit. You'll either take money out of those retirement plans when you decide or when the IRS decides, or your heirs will have to deal with the situation, but we all exit. I encourage you to call 800-928-4001 to meet with one of the talented financial advisors at the Financial Enhancement Group. I've listened to this show for years, and what Joe says just makes sense. Don't you think it's time for you to call 800-928-4001, YourLifeAfterWork.com. Now let's get back to the show.
Well, good morning and welcome back to Consider This. I'm your host, Joe Clark.
And I'm Angie Kinzer.
Happy to have you along, Angie. More importantly, right now, we have a guest host coming in for this part of the show, Andrew Thrasher, Chartered Market Technician, part of the Financial Enhancement Group. Good afternoon, Andrew.
Hey, good to be back here. It's been a couple of weeks, so it's nice to come back on your show. Thanks for having me.
You're always happy to have you. So here's the deal. We got asked a question about ESG investing and how we put those into portfolios. I've had Adam on the show talking about how we use fundamental analysis. I did a part talking about the narrative and how we look at it. And we brought you our own internal expert on the technical analysis. So leaving ESG out of the equation, how do we employ, just in quick broad strokes, how do we employ technical analysis in the portfolios that we build?
Sure. Like everything, we want to approach topics of investing when we're looking at what we want to hold in our portfolios with a risk-first lens. I mean, we want to evaluate how much risk do we want to take on by taking on exposure to individual stocks or ETFs or emerging markets or whatever part of the investment universe we're looking at that time. And so doing so that we look at it from different points of view, we want to evaluate how is that security, that stock, that ETF, how is it performing against the broader market? Is it doing better than the market? Is it doing worse than the market? We really want to evaluate if we're taking on this risk, are we going to get paid, so to speak, for that risk? I mean, are we going to be able to have a higher return than maybe the broad market by kind of taking a step outside of the general market to take on that risk? And so one of the first things what I look at from a technical standpoint is how is that security or that market or what have you, how is it doing relative to the whole market? And then we want to look at that individual security or that stock and determine how is the technical health of it. Is the technical analysis all boils down to supply and demand. And so when we look at the health of a chart, we want to see is there a greater amount of demand, meaning is the market showing respect for the security and pushing the price higher? Seem like there's a good buying support when the stock declines? Does it seem like that investors are coming in to accumulate shares? Kind of overall, from a 10,000-foot view, does the chart look healthy? Is supply demand where we want it to be to take on some exposure? So that's kind of the broad two different areas that we look at from a technical point of view.
So it sounds to me when you structure your answer that way that you could care less if a stock was ABC, DEF, or ESG. Is that a fair statement?
You could take the tickers off and wipe the names off, and that's actually what some traders do. There's one not real well-known mutual fund manager who actually has his analysts take off all identifiers of the securities. It's to take away his biases. If it was General Electric or if it was ExxonMobil or anything like that, to take off anything that would let him know what the company is so he could truly evaluate that stock, whether it's the balance sheet or the chart, from an unbiased point of view. And so it's similar to what I'm less concerned with what the actual company is or what the ETF is. On that initial look, I really just want to know what is the price action telling me.
Now, one of the things that people like to do, we have a tendency to do, whether you're a newscaster, when I've been on CNBC, people are always asking me the why. I think everybody wants to answer the why questions, but at the end of the day, it is possible, based on what you've said, that the world becomes very enamored by the idea of being socially just or worried about environmental issues to the extent that they would push the stock higher. You wouldn't, or a series of stocks higher. You wouldn't care what the reason was because you know that it can't be acknowledged. You just care about the result of the chart. Fair enough?
Yeah. I would broadly speaking, yeah, that's about right.
So when we look, and this is, I think, a very important thing for our listeners, because this whole show has really been about investment strategies and things that are out there. When you talk about balancing, and I think I know your answer on this, but in a balanced portfolio, like we talked about in the first segment, where you constantly go in every quarter and you readjust to say you want 60% equities and 40% bonds, or what we call fixed income. You just do that regardless of what the market does. You just keep your percentages the same. What would a technical trader, and folks, I don't want to overblow this, but Andrew is regarded as one of the best in the business at his part of the T. But what would a technical trader have to say about rebalancing automatically on a calendar date?
So you have, I think when using calendar, anything, I guess would start out with anything is better than nothing. So rebalancing on a calendar basis allows you to, things that might have had a really strong run up, to kind of maybe pull back some of those exposures to where maybe it's gotten to be too large of a percent of your portfolio, and maybe rebalance the things that have to revert or kind of come back to their averages that have declined. So just as things can kind of run away in both directions, where we get too much of an imbalance, as we were talking about earlier, in supply and demand, to where maybe there's been such a decrease in demand for an XYZ stock or what have you, that by rebalancing it will kind of keep you within a tolerance of still having exposure there, and maybe it will come back higher. But it also, by keeping it on a calendar basis, the one benefit that it can have from that is it takes away some of the biases. To say, okay, it's the start of July, or it's the start of the third quarter, whatever methodology used, that you're having a process that you're following, and not letting whatever the latest headline is, not letting whatever the price action from just the day before getting too short term, by really having a process. Okay, this is what I've set out to do, follow that process, and that's where long-term results can benefit, and not letting a lot of those behavioral issues take hold and derail a portfolio.
So I loved the magic. I will tell you, Andrew, the two of us who probably read the most outside of just industry stuff are the two that are on the radio right now. Andrew does a really, really good job reading books and talking about biases.
So they don't have a lot of friends, so I just read a lot.
That's not the excuse I'm going to use there, Mr. Thrasher. But that search for learning and knowledge. So I'd love, because we know where that came from, the bias of taking off the ticker symbols. Is there any other tricks out there that you would quickly tell a family to do that was trying to do this on their own?
I think writing things down can be so important. By something that they teach a lot of students in school is when you have different ways to learn something. If you're hearing it, if you're writing it, if you're explaining it to somebody else, and something you really can start to fully grasp it and learn it. It's not just something that you'll forget the next day after you've heard it one day. So I think really writing down what your process is going to be, saying, okay, if it's going to be a fairly passive portfolio that you rebalance twice a year, write it down and have that to where you can reference back to when the market really is getting maybe crazy, like it did at the end of last year, where we had that big downswing, that you have something tangible, something physical to latch on to. Say, this is my process. Whereas a lot of people try to just keep things mental. And when you keep things mental, that's where your brain can start playing tricks on you. So I think anytime you can truly write down your process, or write down the reasons you've done certain things in your portfolio. One thing we do internally is we keep track of all the trades that we make, why we made them, and we're able to then go back and review that to see, is there any way we can improve? But by having things in writing, allows you to solidify your process and to let you avoid a lot of those behavioral mistakes.
We're able to look at the good, the bad, and the ugly. Absolutely.
Exactly.
Buddy, I greatly appreciate you taking the time to be on the show today. And if you want to know more about how Andrew works inside of the portfolios, of course, you can always go to the website to read about him, yourlifeafterwork.com. Andrew is a big part, not of producing the Market Carver, but a lot of the good thought that goes into the Market Carver. So again, go to the website, yourlifeafterwork.com, get signed up for that. Andrew, we appreciate you. Have a great day.
Hi, Joni Michaels here. We know you care about your money, but are you tired of worrying about it? The Financial Enhancement Group takes care of people just like you who don't want to worry about their money. As fiduciaries, the team at the Financial Enhancement Group will care for your nest egg just like they would care for their own if they were in your situation. There are many decisions you'll need to make as you face retirement, and the team at the Financial Enhancement Group is here to help you. Call 800-928-4001 or go to yourlifeafterwork.com to set up a time to meet. The confusion and complexity of retirement is almost as daunting as is the excitement of retirement. Don't let your fear and frustration of taxes and investing derail your retirement. Call the Financial Enhancement Group at 800-928-4001. They'll give you a complimentary second opinion on your strategy for retirement. Begin your adventure in your life after work. Call 800-928-4001 or yourlifeafterwork.com. Now back to Consider This program with Joe Clark.
Well, good morning and welcome back to Consider This program. I'm your host, Joe Clark.
I'm Ken Dilger.
And I'm Angie Kinzer.
We're happy to have you guys all along. So we have been dealing, we got provoked with a great question over ESG investing. And if you guys have questions or comments, feel free to call 800-928-4001. Just ask for Angie. Or you can go to our website at yourlifeafterwork.com to find out a little bit more about what's going on with us and how we may be of service to you. But you can call Angie and say, hey, you know what? I'm tired of doing this on my own, or something in my life has changed. Like to sit down and share a cup of coffee and just see if having a registered investment advisor or a fiduciary makes sense in your life. We're happy to have those calls. But we got a question over ESG investing. So, Angie, without looking at your sheet, what do the E, the S, and the G stand for?
Oh, come on.
C. E. Let's just start there. E. What's E?
Ask Ken.
Environmental.
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 I would have got that, Joe. You didn't give me a chance.
Okay.
Yes, I know.
What's the S, Ken? What's
Social.
There you go. And what's the G? Governance. That's the hardest one to say.
Yes.
So governance is the hardest one to say. And I think Adam did a really great job. If you missed that, don't forget, you can always go to the podcast wherever you listen to podcasts. Consider this program. You do have to type in the word program. Download it, and you can go back and listen to this whole show. But we are big fans of correct governance. It's one of those things you don't talk about when you always do it, right? And we have a basic rule here. If somebody gets caught with cooking the books, right? And accounting irregularity is the words that we use, because you're always innocent until proven guilty.
I can imagine.
Right? If a few $1 billion is missing out of a checkbook, you're innocent until proven guilty. But if somebody says you said something behind closed doors, you are guilty. Right? No, just might have been a tangent. All right, so we don't pay attention to that kind of headline. We do pay attention to the kind of headline where people are fired or fined or those kind of things, or when the word accounting irregularity are brought up. The question for you, and I wanted to ask Adam this question, we just ran out of time, but it's how did you meet? Right? So, Ken, I always ask people that. Barb and I have been married for 31 years. People will still say, how'd you meet? Right? How'd you and Heidi meet? Where'd it come from? Or how'd you guys meet?
At a bar.
At a bar. Right? True story.
True story.
It works. Mine was through an old girlfriend of, one of mine.
There you go.
And, Angie.
Mine was a blind date setup from friends.
So, see? And isn't it fun to talk about that and kind of relive that? Do you suppose there was anything bad about that meeting that we have forgotten about because it's been so long ago and it was just kind of, we don't want to talk about it anymore. We'll just kind of forget it, going back.
It all depends on how the relationship worked out,
at
right?
the time, right?
Right.
Going back, hindsight, looking at things like, well, is this a good deal or a bad, what we call a trade in the market? Here's my point. We have a natural bias to remember things that went the way we want them to go. Right? Now, notice I didn't say that went well. Right? So when you're mad at your bride, Ken,
Mm-hmm.
you have a propensity to remember many, 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 many other bad things. Right? We have this video that we can show in the back of our heads going, I remember when, I remember when, I remember when, right? Or we can run the video that says, oh, it's Valentine's Day and I'm happy and I can remember when. And I can remember when, right? Genesis is really, really important in terms of how something started, but you've really got to keep track of it. And Andrew talked to you about on his segment about recording the trading stuff. Every position we buy or sell gets recorded and gets judged, good or bad. Did it make sense to own this company? Was it bad? And then we try to go through this. We are not emotionally attached to stocks, right? I will remind you, as I always do, it's okay to be married for somebody for 31 years and talk about what Barb did for me for the last 31 years. That's okay. It is not okay for me to own a stock for 31 years, own it today because of what it did for me in the 80s, 90s, or even 2010, right? That's a different perspective. You can't have an emotional attachment there. But we tend to forget when we've sold things at a loss, right? And we tend to remember when we do this on our own, or we're bragging to our friends or talking to our wives, we tend to remember the good trades we made that made us profitable. Or when we're worried about the market and we want to justify why we're in cash, Angie, we tend to have this analysis that says, well, I knew 2008 was coming, right? And I sold. I got out. I didn't lose the money that my friends did. Now, the problem is none of their friends, because they're agonizing over the pain that we went through in 2008, have enough guts to ask them, when did you get back in, right? Because the majority of time, most of the people who got out didn't get back in. We're getting ready to see a family that's got a little over $2.5 million that got out in 2008, right? And been in cash ever since. And, boy, did they feel good about not missing the calamity of 2008. And boy, are they going now, Joe, I don't get it, right? So remember, markets are not here ever to be your friend. Ken, if you need a friend, Mr. Market is not it, right? I mean, it's seriously, it's just not. And when you look at it and you go through this and you understand, I mean, we can look at 2018, right? So the narrative, my favorite part of the market, trying to explain the why for, right? Should 2018, Angie, been a good year in the market or not? What do you think?
Yes.
Why should it have been good?
Well, I don't know, because employment rates were up.
The unemployment numbers were falling.
Yes.
That's very, very true, right? What else, Ken?
The economy was strong.
Economy was strong. What happened to taxes?
Went down.
Mm-hmm. Taxes got cut. I mean, everybody should have been ecstatic. And in fact, the market was doing real well until September and then not so much. Remember, we ended the year negative last year in the market, in December, the worst December since 1931. And then suddenly we turn around and here we are in 2019. Give me one reason why the world has not gone to hell. You really can't, right? We have tariff talks going on with one of our largest trading partners, not the largest, that's Canada, but one of our largest trading partners. We have tariff talks, right? We have unemployment rate that is the lowest that it's been since the 60s. That really creates a problem for the economy, if you want to know the truth, because it's hard to find people that you need to be able to build an economy that's in there, right? We have record outflows out of money, out of equities, meaning people are pulling money out of the stock market and putting it in the bond market. CEOs in the C-suite, the confidence level has rarely been so low. In fact, it would be difficult for me to tell you why the stock market was up to the level that it is this year, and yet it is, right? And that's because the market is not your friend, right? And so one of those things about how did you meet, documenting this, whether you do it from my side as the narrative, whether you do it Adam's side as the fundamental, or Andrew's as the technical, we prefer obviously bringing all of those together in our strategy. We all three work together to build that portfolio. Right now, we take care of about $485 million for families across the about 31 states. But we do that collectively, not independently, because we don't believe one strategy can really hold up to the crazy world we live in. Give Angie a call, 800-928-4001. If you want to do it on your own, that's your business. If you're looking for a fiduciary, that's our business.
Hi, Joni Michaels here. Joe's been hosting financial radio programs for over 20 years, and during his 7 years at Purdue, Joe developed the 5 critical elements. You see, there are 5 areas we all go through that can impact and even derail our retirement plans. YourLifeAfterWork.com has been focused on you, on your retirement for over 20 years. You may have had a 401k as well as IRAs. Those are all defined contribution plans. Consider this program is about your defined contribution plans becoming defined distributions. You see, we all exit. You'll either take money out of those retirement plans when you decide or when the IRS decides, or your heirs will have to deal with the situation, but we all exit. I encourage you to call 800-928-4001 to meet with one of the talented financial advisors at the Financial Enhancement Group. I've listened to this show for years, and what Joe says just makes sense. Don't you think it's time for you to call 800-928-4001, yourlifeafterwork.com. Now let's get back to the show.
Well, good morning and welcome back to Consider This. I'm your host, Joe Clark.
I'm Ken Dilger.
And I'm Angie Kinzer.
Happy to have you both along. All right, Ange, you've been waiting for this all week. Here we are, Christmas season.
We are. We have 4 days until Christmas, and I'm always interested to see what the hot new item is, whether it's through Oprah, where she gives her whole list of new things, or this article that I found happens to be the hottest holiday toys for 2019. And I thought, okay, I'd be interested to compare what the toys are for 2019 to some of the retro things or retro toys that we may have had. And what I found is there's actually one that is shared on both lists for 2019 and 1955.
Red Ryder BB gun.
No, that's not on top of the list.
They brought that back. I saw somewhere they're bringing the Red Ryder BB gun back.
Yeah, they may.
You're going to shoot your eye out,
You
Joe.
shoot your eye. That's that house is in Cleveland, even though the movie was Northern Indiana,
Right.
and you can stay there now, right? So here we're going to road trip to Cleveland.
It was Terre Haute, wasn't it?
It was no, it was up in the region.
Gary?
I think it was Gary.
I thought it was Terre Haute.
I think it was Gary.
Is there any difference?
It's a north. No, no. We shouldn't say that, but no. It might have been South Bend, and then there would be a big difference. So
South
you got to be
Bend.
very, very careful. Anyhow,
So some of the toys for 2019 are ones I know I haven't heard of. I don't know if you will have, Ken, because I know your kids are a little bit
you
younger.
have a grandchild. Ken and I do not.
She's an infant, though.
I know.
So, okay,
But you're gonna have to learn this stuff.
I mean, there are things on there like baby shark fingerlings. That's number one for 2019.
Okay, pass.
We've got the hatchling toothless baby dragon.
Pass.
Lego Star Wars.
Maybe.
Maybe
I like
that.
Lego.
We got the Paw Patrol Ultimate Fire Rescue Truck.
Clueless.
Doc McStuffins, all-in-one nursery. And now I'm going to give you the answer to what the shared toy is, and then ask you if you have had a couple of these other retro ones. But on the list this year, number 5 is the Hot Wheels Super Ultimate Garage Playset.
Well, yeah. I had Hot Wheels. Did you have Hot Wheels?
For a little bit.
Yeah, we'd set the track up, the little orange track that would snap together, kind of run the cars around. Oh, you betcha.
Well, that's still up there.
I like it.
Now, what I want to know is, have you had any of these? Rock'em Sock'em Robots.
No, of course we did.
Okay. Duncan Yo-Yo. These are all former number one.
Duncan Yo-Yo.
The yo-yo. It's just the Duncan
yeah.
brand.
Well, of course I had it.
Yeah.
Oh, that's right. Yeah, I had a yo-yo.
Okay.
That was 5th and 6th grade, so we are talking about a long, long time ago.
I know. I doubt
this
you
is
guys.
late 70s.
And I doubt you guys had this one, but I know I did. The Easy Bake Oven.
Oh, what?
You had it?
My brother did. He will love that when he hears the show this weekend, but he had it.
Funny.
Oh, we did the little chocolate cakes. Those little bit,
yeah.
like anybody in the Clark family is going to eat a cake that small. But we did do this.
Couldn't
We
eat
did
just one, could you, Joe?
No. It's like where's the Lay's potato chips? All right, what's the last one?
Okay. The last one would be how about the Pet Rock? Do you remember that?
I remember
I
that.
remember it, but I don't
For
remember
whatever
how I
reason, it
had
was number one year, but the Etch-a-Sketch.
The Etch-a-Sketch. Oh, we had
Yes.
those.
Is it coming back?
It is not, but the Cabbage Patch Dolls are
Yeah,
coming
we're
back.
done with that. Hey, folks, I don't care what it is you want for Christmas. I hope you get it. I hope we get a chance to be able to sit down and talk next year. Have a very Merry Christmas. Enjoy your time this holiday season. Have a wonderful week, my friends, and we'll see you next year.
You've been listening to Consider This Program with Joe Clark. As a certified financial planner, former professor at Purdue University, and with 31 years of experience helping families just like you eliminate the fear and confusion of retirement, Joe's team has the answers to your questions. Go to yourlifeafterwork.com or call 800-928-4001 and find a time to meet with the Financial Enhancement Group. There's nothing that will separate you from your retirement as fast as the IRS. There are many questions that can be answered at the Financial Enhancement Group. Questions questions like when to take Social Security, how will my 401k be taxed? These questions are just the tip of the iceberg, and you need to be asking these questions now before it's too late. The Financial Enhancement Group has offices in Anderson, Fishers, and Lafayette, Indiana, but they also take care of families in 30 other states. You care about your retirement, you don't want to worry about your money? Then the Financial Enhancement Group is right for you. As fiduciaries, they are required by law to treat your money as if it were their own and they were in the same situation. Call 800